People who exercise their incentive stock options even a single day early may be subject to a shocking 50% tax. Your incentive stock options are a high-stakes balancing act. If you get it right, you get to enjoy newfound wealth. If you get it wrong, you may be subject to more taxes than you can even afford. And yes, one single day can make the difference between paying thousands and saving thousands. I'm going to cover the two most important things when it comes to your incentive stock options: when to exercise and how to minimize your taxes. ISOs are a tax advantage investment vehicle created by Congress in 1981 by the Economic Recovery Tax Act. When it comes to incentive stock options, there are three important dates: grant date, exercise date, and the date of sale. Let's start off with the grant date. This is where the company offers you a contract where you have the right to purchase company stock. This may come with employment or a promotion. This is the company's way of incentivizing, attracting, and retaining top talent. It's important to note that you are not an owner of the company's stock at grant date, but rather a recipient of a contract. If you agree to the terms and conditions of the contract, you have the right to purchase company stock at a designated price. And that right is time-bound, typically 10 years. The contract includes important details about the company stock options and the rules that you must abide by. Such specifics as when the stock vests, how to exercise, and the grant price of your option. Again, you have to exercise your right in order to purchase company stock, which brings us to the second date, which is the exercise date. While the grant date is decided by the company, the exercise date is your decision. This is where you use the contract to purchase shares of the company. The amount you pay is the grant price times by the number of shares that you're exercising. You figuratively slide the money across the table, and in return, the company issues its shares. It's at this point that you are now an actual owner of company stock. You can only exercise on a company-specific vesting schedule, subject, of course, to early exercising provisions in the contract. This is found in the original contract that you signed at the grant date. Typically, vesting takes anywhere from 4 to 5 years, depending on the company. For a lot of people, exercising early is the better option. If you procrastinate and the 10-year statutory period from which you can exercise passes, you no longer have the right to exercise your company stock options. In this case, the contract will have expired and you lose the right to exercise your options. In addition, if you exercise early, you have more choice in when you want to sell. More on that in just a minute. Just understand that exercising early gives you more freedom and flexibility with when you want to sell. The third date is the sale date. This is the day that you sell your stock. Timing here is also extremely important. One single day can make the difference in paying thousands of dollars in taxes and paying $0 in taxes. Now, here's how to save. Don't sell unless it's been 1 year from the exercise date and 2 years from the grant date. Although you own the company stock, you might not have the ability to sell it. This is where a lot of people run into problems. They think they have access to the money, and when they go to sell it, they can't. This means that the decision to sell might not be totally yours. If it's a private company, they usually offer a small window within which you can sell, which is typically some liquidity event such as a tender offer. This is where the company raises a round of funding and outside investors come and purchase your shares if you want to sell. A lot of times, you can only sell if you had exercised 6 months prior. This is another benefit to exercising early, as I mentioned before. If it's a public company, you're selling it on the exchange in an open market. So it's totally your decision on when to sell. However, public company employees may be subject to lockup periods in the months surrounding an IPO, where they are unable to sell. Now, let's talk about taxes. Taxes on the grant date. Fortunately, there are no taxes on the date of grant for your incentive stock options. Remember, you are not the owner of company stock at this point, but just the recipient of a contract. Taxes on the exercise date. This is where things get tricky. You must plan this date very carefully. A lot of people become subject to AMT, or alternative minimum tax. The AMT tax is a tax calculation that all taxpayers have to calculate, and it's calculated in tandem with your tentative tax on your 1040. You as the taxpayer will have to pay the higher of your tentative tax or the AMT tentative tax. And unfortunately, exercising your ISOs raises your AMT. The goal is to not trigger AMT. In other words, you'll want to exercise just enough ISOs to where your AMT is right beneath your tentative 1040 tax calculation. The amount subject to AMT is going to be the difference between the grant price that was specified in the contract and the fair market value on the date of exercise. AMT can be avoided or prepared for through careful planning with a professional. If caught unprepared, you might not have enough money to pay for your AMT taxes. In cases like that, I know of individuals who have had to forfeit their incentive stock options because they couldn't afford to pay the AMT tax, seeing as that amount was much larger than anything they had ever earned and much larger than their net worth. Lastly is the taxes due on the day of sale. Timing here is extremely important. One single day could save you roughly 30% of taxes. If you exercise one day early, you can be subject to ordinary income tax rates and payroll tax, which is approaching a whopping 50% tax. And that 50% tax doesn't take into account state tax rates, which could be as high as 13%. Just imagine that, having to pay roughly 60% of the value of your incentive stock options to taxes. Ouch. And here's the key. The key here to know is to sell at least 1 year after the exercise date and at least 2 years after the grant date. This will place you in the beneficial capital gains tax rate and help you avoid payroll tax. It's impossible to cover all the complexities and strategies regarding your incentive stock options in one brief video. There is no one-size-fits-all advice for your incentive stock options, so please consult with a financial planner, a CPA, or attorney. If there's one thing you get from this video, it's this. Don't sell until it's been at least a year from exercise and at least 2 years from grant date. Now, here's the bonus you've all been waiting for. If you would like 30 minutes of my time, a specialist in incentive stock options for free, I'm willing to meet with you one-on-one virtually to discuss the specifics of your incentive stock options. Just go to techwealth.pro and schedule an appointment there. Double bonus, in our one-on-one meeting, I will share with you 2 of the biggest financial planning secrets to help you become more savvy with your money. Chances are your financial advisor doesn't know these 2 tricks. Lastly, I wanted to end with this thought-provoking question. Does it make sense to build wealth and become more money savvy? If yes, please subscribe so you can get free advice from a financial planner. Again, visit techwealth.pro to schedule your one-on-one meeting for free. I look forward to seeing you. Thanks for watching.